Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Rachel Winter from Killik Co to give her 3 stock picks. Hi Rachel.
Morning, Emma.
So what's the first stock you'd like to highlight today?
The first one is a company called Teradyne. So this is an American company and it's involved with cobots, or collaborative robots. So we think that's probably one of the big buzzwords of the year. So I think it's quite widely acknowledged we're on the cusp of the 4th industrial revolution. So the first one probably back in the 18th century when hand manufacturing techniques were replaced by steam machines. Then we had electricity coming along. Then we had the digital revolution, so computing and the internet. And the next one is thought to involve automation, artificial intelligence, and more computing and robotics. So that's why we started looking at robotics. Now, Teradyne is actually a business that's been involved in testing semiconductors. And at the moment, that's still the major part of the business. And it's still very important as we start to use more complex chips in our laptops and our phones. But why we like it now is in 2015, they bought a business called Universal Robots. And that's heavily involved in cobots. At the moment, it has over a 50% market share in the cobot space. Last year, the revenue from that division was up 70%, and they think they can achieve over 50% growth per year up out to 2021. So huge growth potential here. And we think this cobot division will become increasingly important for Teradyne.
Now, each of these revolutions, there were winners. Big winners that then went on to dominate the market for, well, nearly centuries after the Industrial Revolution. But there were also losers, particularly thinking of the dot-com bubble bursting. How do you identify a company that's going to thrive in this new AI environment and one that is just an upstart startup?
Well, I think having over a 50% market share at the moment, and I think having such impressive sales growth does give you an indicator that this is hopefully one of the successful ones. And back to your earlier point, I think having a lot of losers from each industrial revolution, I think it's quite important to look at that. And what's quite nice about Teradyne is they're focusing on cobots, so humans working alongside robots. So you're not necessarily getting rid of loads of jobs, you're actually just getting robots to help with the more difficult, the more time-consuming or the more repetitive tasks, and you have still got a lot of humans employed. So that's one other reason why we like it.
And what's the second stock today?
Second one is IBM, so one of the biggest technology companies in the world. And this is one that we think is a little bit misunderstood. So it's very much seen as an old school hardware manufacturing business, and it trades on a price to earnings multiple of 10 times. And that's incredibly low.
Very cheap compared to other tech stocks.
Yeah, and the market in general trades at probably about 16 times. And then some of the bigger tech companies are on 20 or 30 times. So being on 10 times, very low indeed. And that's the sort of multiple you'd expect from a low growth standard hardware manufacturing company. That's not IBM. Over the last few years, they've been selling off their hardware businesses. They've invested in what they call strategic imperatives. And that's things like analytics, cybersecurity, cloud computing, artificial intelligence. And now the revenue from that part of the business is worth more than 50% of their overall revenue. So in our view, IBM is no longer just a hardware manufacturer, and we very much think it's undervalued.
What's the third and final stock?
Third one is Match Group, which I think is quite an interesting one. So this is involved in online dating, which is very much a high growth area. Now Match owns about 45 different dating brands, so really a huge number. And that includes the most well-known ones like Match.com and particularly Tinder. So we think this is a space that is growing very quickly, particularly as it becomes more widely accepted and people become more comfortable with it. So starting with Tinder, that's done very well from the so-called freemium model, where the standard version is free to download and then they can charge users for extra features. And Tinder's got more than 50 million daily active users. It's an incredibly popular app. And then another high growth area for Match is actually the over 50s dating market. So this is a market where people are perhaps more willing and more able to pay. So where there might be less users in this particular segment, they do tend to pay a lot more. So that has been quite profitable for Match over the last couple of years.
Now, there have been some quite high profile companies who've been hit by data breaches. I imagine Match is one of those ones that would have to take that incredibly seriously, given the nature of their business. Is that something that you consider when analysing a stock?
It definitely is. So any technology company, any company involved in handling people's data, particularly sensitive data such as people's dating profiles, I think it's very important to look at that. And I think Match is very heavily involved in looking at their own cybersecurity.
Rachel, thank you very much.
You're welcome.
This is Emma Wall for Morningstar. Thank you for watching.